Hi, welcome to this self-study about risk in the Dutch mortgages. What will we discuss? First of all, we will deal with the question, what is risk? And then we'll have a look at how to mitigate risk. We look at the risk management process, and then we go for risks in the mortgage business, and we end with the four most important types of risks in mortgages. But first, the question, what is risk? Risk is the probability of an event times the impact of that event. That's a long sentence, and we try to explain it. In banking, risk is always defined as a loss, for instance, as a percentage of a loan portfolio, or in dollars, or in euros, etc. And actually, there are two types of loss. First of all, we have what we call expected loss. And expected loss is the average risk, and the loss is included in the price of the product. But we also have unexpected loss. And unexpected loss is the loss in a very unusual situation. And it's of course not in the price of the product, because then we price the product out of the market. So we need something other to cover very unusual situations, and we need financial buffers to deal with that. How does it work? I will give you an example. And the example is about fire insurance. And here you see a number of houses, and imagine these are 1,000 houses. And on average, one of the 1,000 houses will burn down. Here you see the house burns down. The premium, which is paid by all the homeowners of the 1,000 houses, must be enough to cover the damage of one house. So the expected loss is the cost of one house. And the premium, the total premium, is enough to cover the expected loss. But what if you live in California and you've seen it on the television, the enormous fires in the woods over there? So there's not just one house burning down, but there are much more houses burning down. And this is a very unusual situation. So probably the premium is not enough to cover all the claims. But the house owners want to have their house rebuilt and want to have money from the insurance company. So the insurance company only can pay the consumers when they have financial buffers and to pay all the claims, because the total of the claims will exceed the total of the premium. And here you have a good example what's expected loss, one house burning down, and the claim is included in the total premium. Unexpected loss, a lot of houses burn down, the premium in a certain year is not enough to cover the claims, and the insurance company needs financial buffers to deal with that. Can you mitigate all the risks? No. You don't have the budget, or you don't want to have the processes which are a result of all the mitigations. So risk mitigation is always a balancing act between the cost of the risk and the cost and the effects of the mitigations. And now have a closer look at a bank and the risks over there. If we look at a bank, we look at the most important function of a bank, then it is transformation of money. The bank transforms savings into a mortgage. The bank transforms euros in dollars. The bank transforms short money on a saving account to long money in a 10-year fixed mortgage. And if you transform money, there will be risks. If you grant a mortgage, there's the risk that the debtor will not pay back, and we call it credit risk. If you convert dollars into euros, there's currency risk. And if there is risk, then we learned you need to have buffers to cover the unexpected loss. And buffers by a bank, that's the equity of the bank. And the equity is not for free, because we want to have a return on equity, so it comes with a cost. And the cost, that will be translated in the interest rate for the consumer. So it's not only the expected loss, which is direct in the price of the product, it's also the unexpected loss, which is indirect in the price of the product, and that goes through the cost of equity. A little bit of discussion about risk management processes. Suppose you want to start a lender, and you want to grant mortgages. The first thing you have to do is making what we call a credit policy. You think about marketing, which markets do you want to serve? You think about risk, and you think about margin and about risk versus margin. So you make decisions to what people do I want to grant mortgages and what are the risks. And if you've done that, you can start to write your what we call acceptance guide and make your credit scoring and rating models. And with that acceptance guide, you are going to originate mortgages, and you start up to build a portfolio. And during the building up of the portfolio, you monitor the exposure, and you monitor what we call the credit quality. But in the end of the day, not all the debtors will pay. So you need what we call special servicing, dealing with clients who not pay their mortgages. And you have to mitigate the losses, and you have to make provisions for future losses. And the results and what you learn in special servicing, that's used to review the credit policy, maybe to change the risk versus the margin, etc. And now you see that it is a cyclist, it's a loop with feedback. And that's how credit management works in a mortgage company. What types of risks do we see in mortgages? There are 4 types of important risks. First of all, we have credit risk, we have interest risk, we have liquidity risk, and the last one is operational risk. Credit risk. We talk about credit risk to describe the risk that a customer doesn't pay his installments of the mortgage. And maybe he doesn't pay them at all, maybe he doesn't pay them in time, etc. But with mortgages, we have always a house as collateral. So if he doesn't pay, we as a bank always can sell the house. And there's a formula to calculate the expected loss. And it's quite a simple formula with 3 parameters. We have a probability of default. That is the chance that the debtor will not pay his installments. We have the loss given default. That's the amount which is not covered by the sale of the house. And we have exposure at default, and that's, let's say, the total amount in euros at the moment that the loan defaults. If we look closer to these parameters, we see that probability of default, or PD, that's about the debtor, and that has to do with loan to income and with credit history. And our credit history is in the BKR. If you look at the LGD, the loan given default, That has to do with the collateral and especially with the loan to value or LTV. And the exposure at default, that's about the product type and especially do you repay your loan or do you have an interest only loan? So that's about credit risk. Interest risk is also very important. And we talk about interest risk when a lender is not able to earn the projected margin on a loan because the market risk fluctuates or the client repays his loan early and there is not enough penalty or fee to cover the loss of that margin. And there are two important moments in the life of a history when there is interest risk. First of all, when the mortgage during origination is in the pipeline, so that's between the first offer and the moment that we are at the notary and the deed are signed, we call it pipeline risk. And there is prepayment risk for early prepayments. And especially in the Netherlands, there can be prepayments because the consumer sells the house and there is no fee, there's no penalty on that. When the consumer sells his house, he can, let's say, repay the mortgage in total without any type of fee. Liquidity risk. Liquidity risk is when the lender is not able to attract enough funding for the mortgage book or not enough funding at the right price. It was a big problem during the credit crisis, but currently there's so much money, especially from the extended ECB programs, that there's nearly any liquidity risk in the Dutch mortgage market. Banks are enormous liquid at the moment, so there's money enough. And the last risk is operational risk. And operational risk is loss because of errors by people or systems or software or procedures. And fraud is also part of operational risk because our procedures or systems were not good enough to detect the fraud. In summary, we had a look at risk and we started with the question, what is risk? And then we looked at the risk management cycle. And we learned that in the banking environment, risks occur when we are transforming money, and that's one of the major functions of the bank. We discussed the 4 major risks in mortgages, and if you want to learn more about the relation between risks and processes, there are some other modules which are very interesting to follow. That's it for now. I hope I see you in one of the online sessions, and good luck with the other self-studies.